Next step would be to make closing entries. Now, the idea actually for closing entries, it's just remember that it is to close all temporary or the nominal accounts, okay? And temporary or nominal accounts, if you could remember in our previous lesson discussions, these are just the income and the expenses. And these are all seen in your income statement. So that's why I'm here in this sheet for the income statement that would guide me to make the closing entries. And in your workbook, there are 4 steps there to do the closing entries, and that would just be very simple. So first step is you have to close the revenue, all the revenue accounts. In this problem, we only have one revenue account, which is service revenue. So when we say close the account, is to make the account 0, right? And remember, service revenue has a normal balance of credit, right? And for us to close that and make that 0 is to debit it, okay, of the amount of 85,000. So first closing entry would be debit service revenue of 85,000, okay, and we credit that one to income summary, okay. So that would be credit income summary. So income summary is a temporary account as well that we would then also close to capital later, right? And then explanation here to close income accounts. Right, next step is to close all expense accounts. So what you do is just look at the expenses in your income statement, and expense, to close it, it has a normal balance of debit, so we will all credit them. And the partner debit would be income summary. So debit income summary by the total of that, and you credit each expense. So credit salaries expense, 22,000, sorry, should be here. 22,300 credit. We have utilities expense of 10,700. Okay, we have supplies expense of 5,000. Right, then we have rent expense of 10,000. Then finally, depreciation expense. Oopsie, depreciation expense at 250. So what's the total expenses? Okay, one way in Excel is you highlight them and the sum is here. You can see that one. So 48,250. 48,250, or the sum that we have in our income statement here. Okay, next is we will also close our drawing account. So you look at now the statement of owner's equity. The drawing has 6,500. Okay, we close that to capital. Now remember, withdrawal has a normal balance of debit. To make that 0, we have to credit it. So that would be credit, what is the name again of the account? So let's say C or Carmel. Yeah, I can remember. Carmel withdrawals. Okay, which is at 6,500. Okay, and then we will debit here the capital, so which would be Carmel capital, which is at 6,500. And lastly, we will also close, so the explanation here is to close expense accounts. Okay, this one is to close drawing account to capital. Okay, I'll leave a space so it doesn't look there. Then the fourth closing entry would be to close our income summary to capital. Okay, you look at now our income summary. Income summary here has a credit of 85,000 and it was debited here of 48,250. If we deduct them, the difference would be, oopsie, there is a formula in that part, minus this one. Okay, that would be 36,750. right? And that is actually your net income. So since if you got here the difference of 36,750, you look at now what is the balance. 85,000 is higher and it was credited income summary, meaning it has a credit balance, the income summary of 36,750. We have to make the income summary 0. So if it has a credit balance of 36,750, and to make it 0, we have to debit income summary to Carmel Capital, which is at 36,750, which is actually your net income. Okay, that's why it's called income summary as well. So that would be to close income summary to capital. So if you try to see, to close the income summary, we credit the capital, right? And crediting capital is basically increasing capital. So meaning a net income generally increases capital. If this was a net loss, it would be the other way around. That would be debit Carmel capital, credit income summary. So a net loss decreases your capital. So that is what we do here now for the closing entries.